Hello, everybody, and welcome to Accounts Receivable Part 1. This is my overview of accounts receivable. So let's kind of talk about a little bit about accounts receivable. So we've kind of seen the origin of this is when we have a sale and we extended a credit to a customer. So our example here is on January 1st, 2025, YYZ sells LAX $50,000 of inventory on account. The inventory cost YYZ 20 grand with the terms 210 net 30. Assuming no sales tax, this is what it would look like. I'm debiting accounts receivable because I'm not getting cash. Remember, accounts receivable is a holding account until I receive the cash. But the key thing is here is I went through and I extended credit to LAX. And this is where we kind of get into the biggest issue is what happens if LAX does not pay YYZ. And this is by far one of the most important things about a business. And when you are a CFO, assistant controller, controller, accounting manager, managing your accounts receivable is extremely important. Remember, if you have salespeople care about commission. They probably do not care about whether or not the company gets paid. They want to make money on commissions. They want to make the sale. But what you have to do as the accountant is to make sure that you can collect. So I'm going to share with you something that happened to me. I cost two clients of mine over 10 years ago $50,000. And it was not any immediate fault of my own. Rather, had I done a background check when someone had recommended me to this company, I would have saved my company $50,000. So the thing that you should know, anytime you're going to be doing a significant transaction with any kind of fund or before you give money to somebody, you have to go through and do a background check. And there's firms that will go out and do this for you. We'll talk about that just in a little bit. And even if you're going to be acquired by a company, I was the CFO of a company. Biggest mistake I made was listening to the attorney who said, "Hey, Bennett, they're coming with a check. That's all you have to worry about." Oh, no. If that company is going to assume your liabilities, the moment they acquired us, we had vendors taking stuff out of our offices earlier. And it was because that firm had declared bankruptcy and cost those vendors money. So again, you have to be very, very careful about who you do business with. So before we make this sale, we have to know who we're selling to. By the way, just because they are a publicly traded company doesn't mean that they're not going to be paying you. I have had students tell me that their husbands have been doing work for a large home builder and publicly traded, looks really good. Her husband's company had not been paid in 150 days. And when you think about that, if you're installing carpets and you don't get paid, that's a huge problem. So just because Mattel, they have been hugely impacted by Toys R Us's bankruptcy. And all these vendors are going to be out money. So you have to be really careful about who you sell to, not only just initially, but it's going to be a continued way to go through and evolve. So when you're the CFO, controller, or assistant controller for a company, the collection of accounts receivable is vital. You're going to be preparing that weekly or monthly cash flows. You're going to be calling customers to request payment. You're going to ensure that you've complied with that client's procedures prior to sending the invoice. What does that mean? Well, if I'm selling to a company that requires a purchase order, which is a PO, I need to make sure that I have a PO number. I want my accounts receivable person call up the company and saying, "Hey, this is Bennett. How are you today? Yeah, I just want to check in and to see if you got that invoice. Can I come by and collect that money?" That's what you have to go through and do. You also need to see too, is that can you limit a salesperson ability to collect commission if you don't collect a receivable? That can be a great way to make sure that that salesperson is on board prior to them getting a commission. If you hit the salesperson's pocketbook, that will truly impact them. Now, even if you're not even perfect, right? So there's no way you're going to stop every AR from being perfect. However, I'm going to share with you the link from Inc. magazine. A guy by the name of Darren Dahl wrote this, and I really love the way he set this out. And here you go. So he laid out these facts and how to assess the credit risk of your customers. Have a frank discussion with the customers about payment. When do you expect to be paid? When will the customer be paying you? Run a credit report done in Bradstreet on basically check out the company you're going to be doing business with. If you're going to be extending a huge amount of line of credit, saying you don't have to pay me 50 grand for a period of time, you want to spend the money on a background check. We're going to run a credit report, DMB consumers. Now, depending on the state you're in, there can be major limitations on this. So you have to be very, very careful. Check references, not just the ones that are being given to you by the company. Remember, those are going to be friends of Bennett, right? No, those will be friends of whoever it is going to be. You need to go out and do your own reference checks. Do your homework, right? Go through, look at the financial statements of the company if you can get it. And then obviously, if you can get your money up front, that's going to be even better. So I want to thank you. This is an overview of accounts receivable. Please leave any kind of questions that you might have below, and appreciate you liking and subscribing to the channel. I look forward to seeing you on the next video. Have a great day.